Picture 1933. A farmer in Ohio is sitting at a kitchen table under a single bare bulb, filling out a federal tax form by hand. He has lost half his crop, his truck broke down hauling what was left, and his neighbor just walked off his land for good. But that farmer knew something that most Americans today have completely forgotten. The tax code written during the worst economic collapse in American history was built to protect people exactly like him. And here is the thing that should stop you cold. Most of those protections are still sitting in the code right now, waiting for someone to claim them. Here is the context you need before we go through all 25 of these. In 1939, only about 5% of American workers paid federal income tax at all. The code was not built for a mass taxpayer base the way it is today. It was built for a specific, narrow slice of the population, and it was packed with targeted relief provisions because Congress was trying to keep the economy from completely collapsing. The Revenue Act of 1932 raised the top marginal rate from 25% all the way to 63%. By 1935, the wealth tax pushed rates to 75% on the highest earners. The deductions written into those acts were survival tools, and many of them have never been repealed. Deduction number 1. Casualty and theft losses. Depression-era Americans lost property constantly, to floods, to fires, to bank collapses, to outright theft when desperate neighbors took what they needed. Congress wrote a deduction for unreimbursed casualty and theft losses into the code specifically because ordinary people could not afford insurance. That deduction still exists today under IRS Publication 547. If you suffer a federally declared disaster loss, an unreimbursed theft, or a sudden accidental destruction of property, you can deduct the amount that exceeds 10% of your adjusted gross income. The rule is written down. Most people just never read that far. Deduction number 2. Home mortgage interest. This one traces directly to the Revenue Act of 1913 and was reinforced throughout the Depression years when Congress was desperate to keep homeowners from defaulting en masse. The logic was simple. If you let people deduct the interest they pay on a home loan, they have more cash to stay current on that loan, which keeps banks solvent and keeps neighborhoods intact. That same deduction is still available today under IRS Schedule A for mortgages up to $750,000 on a primary or secondary residence. If you are over 55 and still carrying a mortgage, this deduction is one of the largest single write-offs available to you. Deduction number 3. State and local taxes, commonly called SALT. Depression-era taxpayers were getting hit from every direction: federal tax, state income tax, and local property tax all at once. Congress allowed a deduction for all of those payments against federal taxable income starting in the early 1930s. Today that deduction is capped at $10,000 per household under the 2017 tax law changes, but it still exists, and it is still worth claiming on Schedule A. If you own your home and pay property taxes, you are almost certainly leaving money on the table if you are not itemizing and capturing this deduction every single year. Deduction number 4. Charitable contribution deductions. This provision goes back to 1917 but was expanded dramatically during the Depression because private charities were the primary safety net. There was no Social Security yet, no federal unemployment insurance, no Medicare. Churches, soup kitchens, and community organizations were keeping people alive, and Congress wanted to incentivize donations to keep those organizations funded. The charitable deduction survived every tax overhaul since then. Today you can deduct cash donations up to 60% of your adjusted gross income, and non-cash donations up to 50%, all documented on Schedule A. This is not a loophole. This is the law. Your law. Deduction number 5. Medical expense deductions. During the Depression, medical bills were catastrophic and uninsured. A single hospital stay could wipe out a family's savings entirely. Congress wrote a deduction for extraordinary medical expenses into the tax code to prevent medical debt from creating a second wave of financial ruin on top of the economic collapse. That deduction still exists today. Under current IRS rules, you can deduct unreimbursed medical expenses that exceeds 7.5% of your adjusted gross income. For a retiree on a fixed income, that threshold is often reachable. Prescription drugs, dental work, vision care, long-term care premiums, all of it counts. Deduction number 6. Business expense deductions for the self-employed. In the 1930s, a huge portion of the American workforce was self-employed: farmers, tradesmen, traveling salesmen, small shop owners. Congress recognized that these workers had legitimate costs of earning income that should not be taxed as profit. Tools, supplies, vehicle costs, advertising, even the cost of a work uniform were written into the deductible expense framework. Today, Schedule C still honors every one of those categories. If you do any self-employment work in retirement, even part-time consulting or contracting, you are entitled to deduct the ordinary and necessary expenses of running that business against your self-employment income. Deduction number 7. Home office deduction. This one surprises people because they think it is a modern invention tied to remote work. It is not. Depression-era tradesmen and salesmen who worked out of their homes were allowed to deduct the portion of their home used exclusively for business. The IRS formalized this into what is now the home office deduction, available under IRC Section 280A. If you use a dedicated space in your home regularly and exclusively for self-employment work, you can deduct a proportional share of your rent or mortgage interest, utilities, and insurance. The simplified method allows a flat $5 per square foot up to 300 square feet. Deduction number 8. Vehicle and mileage deductions for business use. During the Depression, a working man's truck or car was often his most valuable business asset. Congress allowed the deduction of vehicle costs tied to earning income because taxing a man on the gross revenue from a delivery route without accounting for the cost of the truck making those deliveries was recognized as fundamentally unfair. Today the IRS sets a standard mileage rate each year, which for 2025 was 70 cents per mile for business use. If you drive for any self-employment purpose, every one of those miles is a documented deduction. Keep a mileage log and you are capturing a deduction that has been in the code for nearly a century. Deduction number 9. Bad debt deductions. This is one that almost nobody talks about today but was critically important during the Depression. When banks failed and businesses collapsed, creditors were left holding worthless notes. Congress allowed a deduction for business bad debts, money you were legitimately owed that became uncollectible. If you loaned money as part of a business transaction and that debt went bad, you could write it off. That provision still exists today under IRC Section 166. If you are a small business owner or self-employed and you have invoices that have gone completely uncollectible, those losses are potentially deductible as business bad debts in the year they become worthless. Deduction number 10. Investment interest expense. Depression-era investors who had borrowed money to buy stocks or bonds and watched those investments collapse were allowed to deduct the interest they paid on those investment loans against their investment income. Congress saw this as basic fairness. If the income from an investment is taxable, the cost of financing that investment should be deductible. Today, under IRC Section 163D, you can still deduct investment interest expense up to the amount of your net investment income. If you are carrying margin debt in a brokerage account or borrowed against assets to make investments, this deduction is still fully available to you. Deduction number 11. Net operating loss carryforward. This is one of the most powerful provisions in the entire tax code, and it was born directly out of the Depression. When a business lost more money in a year than it earned, Congress allowed that loss to be carried forward and applied against future profitable years. The logic was that you should be taxed on your average income over time, not punished in a good year for having survived a bad one. Today, under current IRS rules, net operating losses can be carried forward indefinitely, and can offset up to 80% of taxable income in future years. If you had a business loss in a prior year that was not fully used, it may still be sitting on your books waiting to reduce your current tax bill. Deduction number 12. Depreciation of business property. Depression-era business owners who owned equipment, machinery, or buildings used in their trade were allowed to deduct the gradual wearing out of those assets over time. This was not a giveaway. It was an acknowledgement that a printing press or a grain elevator loses value every year it operates, and taxing the gross revenue of a business without accounting for the cost of the assets producing that revenue is economically incoherent. Today, depreciation under IRS Publication 946 is still one of the largest deductions available to small business owners. Section 179 expensing even allows you to deduct the full cost of qualifying equipment in the year you buy it. Deduction number 13. Alimony payments. The Depression shattered a staggering number of American marriages. Economic stress, foreclosure, and unemployment drove divorce rates in ways that Congress could not ignore. To prevent divorced men from being taxed on income they were legally required to pay to a former spouse, Congress made alimony payments deductible for the payer and taxable to the recipient. For divorce agreements executed before January 1, 2019, that Depression-era framework still applies exactly as written. If your divorce decree predates 2019, you may still be deducting those payments today under the original rule that has been in continuous operation for nearly 90 years. Deduction number 14. Educator expense deduction. This one has Depression-era roots that most people never connect to the classroom. During the 1930s, public school teachers were often paid in scrip, IOUs, or simply not paid at all, and many continued buying basic classroom supplies out of their own pockets because the alternative was no education for the children in front of them. Congress eventually codified the principle that educators who spend their own money on classroom supplies deserve a tax break for it. Today, the Educator expense deduction allows eligible teachers and school professionals to deduct up to $300 per year for unreimbursed classroom expenses directly on the front of Form 1040. No itemizing required. Deduction number 15. Rental property expense deductions. During the Depression, many Americans who lost their primary income turned to renting out rooms or properties as a survival strategy. Congress recognized that a landlord's gross rental income was not profit. It was gross revenue against which maintenance costs, property taxes, insurance, and mortgage interest had to be netted before any real income existed. Every one of those expense categories is still deductible today against rental income on Schedule E. If you own rental property, you are entitled to deduct repairs, property management fees, advertising, insurance premiums, property taxes, and mortgage interest. These deductions have been in continuous operation since the 1930s. Deduction number 16. Farm expense deductions. Agriculture was the backbone of the Depression-era economy, and Congress wrote some of the most detailed and durable deductions in the entire tax code specifically for farmers. Seed costs, fertilizer, livestock feed, equipment repairs, hired labor, and even the cost of draining a field were all written in as deductible farm expenses. Today, Schedule F still carries virtually every one of those original categories. If you own farmland, operate a small agricultural operation, or even maintain a working orchard or garden operation that generates income, you are operating under a tax framework that was written to keep American agriculture alive during the worst decade in its history. Deduction number 17. Timber depletion deduction. This is one of the most obscure surviving Depression-era provisions, and one of the most valuable for anyone who owns forested land. Congress wrote depletion deductions for natural resources including timber because a landowner who harvests trees is not earning pure profit. They are liquidating a capital asset that took decades to grow. The depletion deduction compensates for that asset reduction. Today, under IRC Section 611, timber depletion is still a fully available deduction. If you own wooded land and have ever sold timber rights or harvested timber commercially, you may have a significant unclaimed deduction sitting on property you have owned for years. Deduction number 18. Oil and gas depletion allowance. The oil and gas depletion allowance is one of the most politically debated surviving Depression-era deductions in the tax code, but it is still there and it still works. Congress established it to encourage domestic energy production during a period when energy independence was considered a national security issue. Under current IRS rules, independent oil and gas producers and royalty owners can still claim a percentage depletion deduction of 15% of gross income from oil and gas wells. If you own mineral rights or receive oil and gas royalty income, this deduction was written for exactly your situation, and it has never been repealed. Deduction number 19. Union dues and work-related expenses. During the Depression, labor union membership was a lifeline, and Congress recognized that the cost of maintaining union membership was a legitimate expense of earning income. Work-related expenses including union dues, required work clothing, and tools not reimbursed by an employer were deductible. Today, the direct employee deduction for union dues was suspended for W-2 employees under the 2017 tax law through 2025, but self-employed workers and certain state tax returns still honor it fully. More importantly, if you are self-employed and pay professional association dues or required licensing fees, those costs are still fully deductible as ordinary and necessary business expenses on Schedule C. Deduction number 20. Moving expenses for active duty military. During the Depression and especially through World War II, Congress wrote moving expense deductions for workers who had to relocate for employment because the cost of uprooting a family was recognized as a real economic burden. The general moving expense deduction was later suspended for civilian taxpayers, but Congress specifically preserved it for active duty military members who moved pursuant to a military order. Under current IRS rules, active duty service members can still deduct unreimbursed moving expenses on Form 3903. If you have a family member on active duty who has moved under orders, this Depression-era framework is still protecting them today. Deduction number 21. Student loan interest deduction. The roots of this deduction trace to Depression-era provisions that recognized education costs as an investment in earning capacity rather than personal consumption. Congress has consistently held that the interest paid on debt incurred to produce future income deserves some deductibility. Today, under current IRS rules, you can deduct up to $2,500 of student loan interest per year directly on Form 1040 without itemizing, subject to income phase-outs. If you are paying off your own student loans in retirement, or co-signed loans for a child and are making payments, this deduction is available and it requires no Schedule A. Deduction number 22. The standard deduction itself. Most people do not realize that the standard deduction has Depression-era origins. Before 1944, every taxpayer had to itemize every single deduction individually, which was a paperwork burden that fell hardest on working-class filers who could not afford accountants. Congress introduced a simplified standard deduction in 1944 specifically to reduce that burden and ensure that even people without professional tax help could capture a baseline reduction in taxable income. Today, the standard deduction for a single filer over 65 is $16,550 for 2025, and married filers over 65 get an additional $1,550 per spouse on top of that. It is already yours. You just have not claimed it yet. Deduction number 23. The additional standard deduction for age. This one is directly descended from Depression-era relief provisions for elderly Americans who had no Social Security, no pension, and no safety net. Congress recognized that older Americans on fixed incomes faced a disproportionate tax burden relative to their actual ability to pay. That principle was eventually codified as an additional standard deduction for taxpayers aged 65 and older. For 2025, that additional amount is $1,550 per qualifying person for married filers and $1,950 for single filers. If you are 65 or older and filing taxes, you are entitled to this extra deduction automatically. No form to file, no application, no approval process. Deduction number 24. Self-employed health insurance premium deduction. During the Depression, health insurance as we know it barely existed, but the principle that a self-employed worker's cost of protecting their own health was a business expense rather than personal consumption was embedded in the tax code early on. Today, under IRC Section 162L, self-employed individuals can deduct 100% of health insurance premiums paid for themselves, their spouse, and their dependents directly on Form 1040, before calculating adjusted gross income. This is an above-the-line deduction, meaning you do not need to itemize to claim it, and it applies to Medicare premiums if you are self-employed and enrolled in Medicare. Deduction number 25. The earned income principle behind retirement account contributions. This final deduction is the capstone of the whole framework. Depression-era tax policy was built on a foundational principle. Income that you set aside today to survive tomorrow should not be taxed today. That principle drove the creation of what eventually became IRAs, SCPIRs, and 401k plans. For 2025, if you are self-employed and under 73, you can contribute up to $69,000 annually to a SCPIRA and deduct every dollar of it. Traditional IRA contributions remain deductible up to $7,000, with a $1,000 catch-up contribution allowed for those 50 and older. The Depression-era logic of deferred taxation on survival savings is alive and fully operational today. Now let us talk about why so many of these deductions go unclaimed every single year. The IRS does not send you a letter telling you what you qualify for. It does not flag your return and say you missed one. The system is entirely opt-in. You claim what you know about, and the IRS keeps the rest. Depression-era Americans who used these deductions did so because their survival depended on knowing the rules. They had tax preparers, accountants, and union advisors who walked them through every line. Today, a huge percentage of filers over 55 take the standard deduction and stop there, never checking whether itemizing or claiming above-the-line deductions would put more money back in their pocket. Let us go through this slowly, because the details are where the money lives. The above-the-line deductions are the ones you should check first, because they reduce your adjusted gross income before you even get to the question of standard versus itemized. That matters enormously because your AGI is the number that determines your Medicare premium surcharges, your eligibility for certain credits, the taxability of your Social Security benefits, and your exposure to the net investment income tax. Every dollar you legitimately reduce your AGI by is not just a dollar off your federal tax bill. It is potentially a dollar that keeps you below an income threshold that triggers a whole separate set of costs. Here is the specific Social Security connection that most people miss entirely. If your combined income, which the IRS defines as your adjusted gross income plus non-taxable interest plus half of your Social Security benefits, exceeds $34,000 as a single filer or $44,000 as a married filer, up to 85% of your Social Security benefits become taxable. Every legitimate deduction that reduces your AGI is a direct defense against crossing those thresholds. The Depression-era framework of deducting real costs of earning and surviving income was not designed with Social Security taxation in mind, but it functions today as one of the most effective tools for keeping more of your Social Security benefit out of the IRS's reach. The Medicare premium surcharge connection is equally important and equally overlooked. Medicare Part B and Part D premiums are not flat rates. They are income tested under a system called IRMA, the Income-Related Monthly Adjustment Amount. For 2025, a single filer with modified adjusted gross income above $106,000 pays significantly higher Medicare premiums than someone just below that threshold. The difference between the base premium and the top IRMA tier can exceed $4,000 per year. Every deduction that legitimately reduces your modified AGI is a potential Medicare premium reduction. This is not a coincidence. This is exactly the kind of compounding benefit that the Depression-era deduction framework produces when you use it correctly. Now let us address the documentation question directly, because this is where people get nervous and decide not to claim things they are fully entitled to. The IRS does not require you to submit receipts with your tax return. What it requires is that you have documentation available if you are ever audited, and that the deductions you claim are accurate and substantiated. For most of the deductions we have covered today, the documentation standard is straightforward: bank statements, credit card records, medical bills, property tax statements, and mileage logs. Keep a folder, physical or digital, organized by deduction category. The Depression-era Americans who claimed these deductions kept their receipts in shoeboxes. You can do at least that well. Let us talk about the audit risk reality, because this is the other thing that stops people from claiming legitimate deductions. In 2023, the IRS audited approximately 0.44% of individual returns, less than 1 in 200. For filers earning under $200,000, that rate was even lower. The deductions we have covered today are not aggressive tax positions. They are not gray area strategies. They are explicitly written provisions of the Internal Revenue Code that have been in continuous operation for decades. Claiming a deduction you are legally entitled to is not a red flag. Failing to claim it is simply leaving money behind. They count on you not knowing. That stops today. Here is a practical action step you can take this week. Pull your last filed tax return and go through it line by line against the 25 deductions we covered today. You are specifically looking for above-the-line deductions you may have missed: self-employed health insurance premiums, SEP/IRA contributions, student loan interest, and the additional standard deduction for age 65 and older. These do not require itemizing. They come off the top before you even calculate your standard versus itemized choice. If you find a deduction you missed in a prior year, you have 3 years from the original filing deadline to file an amended return on Form 1040X and claim a refund. 3 years. That window is open right now for tax years 2022, 2023, and 2024. There is one more thing worth saying about the historical record here. The people who wrote these deductions into the tax code during the 1930s were not doing favors for the wealthy. The wealthy had armies of accountants and did not need help finding deductions. These provisions were written for the farmer who lost his crop, the tradesman whose truck broke down, the widow who rented out a room to make ends meet, the small business owner who watched his receivables go worthless overnight. The code was written for people who worked hard, paid in, and needed the system to acknowledge that real economic life involves real costs. That acknowledgement is still in the code. It has been there for nearly a century. Let us also address the question of whether working with a tax preparer changes any of this. If you use a tax professional, bring this list to your next appointment and ask them specifically whether each applicable deduction was captured on your last return. Do not assume they found everything. Tax preparers work quickly, they work with the information you give them, and they are not always incentivized to ask the questions that surface smaller but legitimate deductions. You are the one who knows your situation. Whether you drove for business, whether you had unreimbursed medical expenses, whether you own timber or mineral rights. The professional's job is to apply the code to the facts you provide. Your job is to know enough facts to provide. One category that deserves its own moment is the long-term care insurance premium deduction, which carries the DNA of the Depression-era medical expense framework. Congress has always recognized that the cost of insuring against catastrophic health events is not a luxury expense, it is a survival expense. Today, under IRS Publication 502, premiums paid for qualified long-term care insurance are deductible as medical expenses. The deductible limit is age-based. For taxpayers age 61 to 70, the 2025 limit is $4,710 per person. For those over 70, it is $5,880. If you are paying long-term care premiums and not capturing this deduction, you are paying taxes on money you spent protecting yourself from a catastrophic health event. The energy efficiency angle also has Depression-era roots worth understanding. The Rural Electrification Act of 1936 and related New Deal energy programs established the principle that improving the energy efficiency of American homes and farms was a public good worth incentivizing through the tax code. Today, the Residential Clean Energy Credit and the Energy Efficient Home Improvement Credit carry that legacy forward. Under current law, you can claim a credit of up to $3,200 per year for qualifying home energy improvements including insulation, heat pumps, and efficient windows. Credits are better than deductions. They come directly off your tax bill, not just off your taxable income. If you have made any qualifying home improvements, check Form 5695. Here is the summary picture you should carry with you after this video. The tax code is not a single document written by one Congress at one moment in time. It is a layered accumulation of provisions written across nearly a century of American economic history. The Depression-era provisions we covered today were written by people who understood economic hardship in a way that most modern legislators do not, and they wrote protections that were durable enough to survive 90 years of tax reform, political change, and economic transformation. Most of those protections are still in the code right now. The question is never whether you deserve them. The question is only whether you know they exist. Before we wrap up, let me give you the 3 things to do this week. First, pull your last tax return and check whether you claimed the additional standard deduction for being 65 or older. It should be on the front page of Form 1040, and if it is not there, file a Form 1040X amendment. Second, if you have any self-employment income at all, check whether you deducted health insurance premiums and business expenses on Schedule C. Third, if you own property, rental units, farmland, timber, or mineral rights, verify that every applicable deduction category on Schedule E or Schedule F was captured. These 3 checks alone have recovered thousands of dollars for people who thought they filed correctly the first time. The Depression generation did not leave money on the table. They could not afford to. They read the forms, they asked the questions, and they claimed every dollar the law allowed them to keep. You have the same law available to you right now. The provisions we covered today are not historical curiosities. They are active, living sections of the Internal Revenue Code that the IRS is legally required to honor when you claim them correctly. You paid into this system for decades. The deductions we covered today are the system's acknowledgement that real economic life has real costs, and that those costs deserve recognition. It is already yours. You just have not claimed it yet. If this video put money back in your pocket or opened your eyes to a deduction you have been missing, hit that subscribe button right now. Every video on this channel covers a real, documented right or benefit that is sitting unclaimed in the federal code, waiting for someone to know where to look. We cover Social Security rules, Medicare guidelines, tax law, and federal benefit codes, all of it sourced and specific, because you deserve to know exactly what you are owed. Leave a comment below telling me which of these 25 deductions was new to you. I read every one of them, and your questions shape what we cover next. The rule is written down. Most people just never read that far. We read it for you, every single week.